The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
April records bring May gains. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Katie Greifeld.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. and the melt-up continues in equities because we're now looking at a 7th straight day of gains for the S&P 500. It's given back a little bit of the advance as we head into the final hour or so of trading, but we are still looking at a record high for the S&P, and we are on course for the 9th straight weekly gain as well, with tech leading the way today as well as for the month. The VIX has inched lower to just about 15.5. That is clearly no sign of anxiety here, and as recently as March 27th, it was at a 31 handle. New York crude down about 1.5%, just trading below $88 a barrel. The U.S. and Iran tentatively agreeing to extend the ceasefire, the fragile ceasefire, by another 60 days. And no real change here in the 10-year yield, 4.44%. Katie.
Let's talk a little bit more about those stock market superlatives because we've got gains on the day, on the week, and on the month as hopes that a ceasefire deal could pave the way for an end to the Iran conflict, really fueling that Wall Street optimism. Treasuries, meanwhile, are set for their best week since the war began, and oil retreating. And now the S&P 500 surging nearly 20% since its Iran war lows. And as Scarlett mentioned, the S&P 500 will finish today with its 9th straight weekly advance, which is the longest stretch all the way back to 2023. Earnings momentum boding well for the month of May, with all the major averages also finishing higher than where they started. The NASDAQ specifically rising nearly 10% this month alone. And you can thank retro tech for that move because infotech has led sector gains on the back of that AI narrative, evidenced by earnings, valuations, and momentum. Dell today soaring the most in 2 years after its mic-dropping report and outlook fueled by AI demand. Tech is likely to remain in the headlines as we head into the week ahead, with NVIDIA's Jensen Huang leading a parade of AI leaders in Taiwan for Asia's biggest technology showcase, Scarlett. So definitely keep an eye on that.
Oh, we certainly will. Let's dig a little deeper into that idea of tech doing its thing. The AI narrative is clearly helping the hardware space, and that is the blue line here. You can see it's really taken off. Shares of Dell, Katie, as you mentioned, and NetApp each climbing more than 25% today on the back of strong earnings to new record highs. HPE rallying today before its results on Monday, also to an all-time high. Even software, and that's the white line here, has staged a comeback. You can see investors began punishing the group in the fourth quarter of last year on concern over competition from AI. And while software is still trading well below its highs here, the shares have rebounded more than 20% off their lows. And believe it or not, Katie, software is in a bull market.
I believe it, Scarlett. Let's keep the conversation going with Michael Arone. He is Chief Investment Strategist and Managing Director over at State Street Investment Management. Michael, great to have you with us. I want to go to the first line in your notes because you write that investors need to summon the courage to follow the fundamentals. I love it, but I want to understand a little bit more what that means because we are at record highs when you take a look at the S&P 500.
So the old market rules would have suggested to sell in May and go away. But in today's market, the smarter play may be buy AI and ride the wave. So one of the things I think is really interesting about today is there was never a 9-week winning streak in 1999. But after a 9-week winning streak, what we've observed historically over 3 months, 6 months, and 12 months, our returns are pretty solid when we look at those handful of periods. In fact, 12 months forward, returns are more than 11%. And here's the thing, unlike 99, today earnings growth is almost evenly matched with returns. I'll do this quickly. The cumulative earnings growth over the last 5 years, 80%. The total return, or S&P 500, 85%. When we look at those same numbers in the 95 to 99 period, earnings growth was 67%, and the total return was 220. So that gap was much bigger. So this is driven by fundamentals and earnings.
So what would be the courageous thing to do in this market then, Michael? Walk us through it.
So I do think that investors continue to have a heavy dose of skepticism, of anxiety about kind of the ominous, foot that's going to fall and kind of rattle. So I think the thing to do is continue to stick with what's winning and continue to stick with earnings growth. Now, we do think that kind of there is a dual threat to the potential of the rally, and we got a bit of a glimpse of that a couple weeks ago when rates were ticking higher, but now, as you mentioned in your opening remarks, they're starting to tick down a little bit. And I also think that there's a nervousness that ultimately expectations are too high, and if we fail to meet those expectations, so earnings growth is solid. It's expected to grow by 15% next year, but that may not be enough to sustain the rally. So I think you should continue to look for investments that have high earnings growth, that benefit from the AI infrastructure build out, as well as some of the kind of structural changes we're seeing in the economy.
So, Michael, where do software stocks fit into that dynamic? What are the fundamentals for this group, which are vulnerable to competition from AI? We know that, but probably not immediately and probably not simultaneously at a time when they're no longer oversold. I'm wondering if fear of the unknown is probably the bigger catalyst than actual demand destruction for their products.
So I think it may seem strange coming from someone like myself, who's obviously representative of exchange-traded funds. But as it relates to software, I think selection's the key. So I think that AI will create enormous amounts of value, but it will destroy and upend a tremendous amount of operating models, including in the software space. And we saw the fears of that really during the SaaS apocalypse, where it was sell first, ask questions later. As an investor, I think that creates opportunities. So I think there is an opportunity for astute investors to use selection within software to actually determine the winners and losers. And I think that's where we're headed in terms of the AI CapEx cycle, is rather than invest in the same old, I'm looking for some of the kind of the transformation companies that will accelerate the adoption. When we look at, I know that Dell's not a software company, but when we look at Dell, for example, today, it's a beneficiary of all of the widespread spending. There are more of those companies, and there are nuggets of value in software that will likely benefit from AI. It's just determining the winners and losers that will be key. And of course, there's funds and ETFs and managers that do that for you, that are able to do that.
Katie and I appreciate the references to ETFs, given that we also host the ETF IQ show. You have this thesis where investors should reposition themselves for the next wave of AI and economic realignment. And as part of that, you say look to the emerging markets and those stocks as one area. EM stocks are actually on pace right now for their largest quarterly outperformance versus developed markets since 2009. So I guess my question is, do you see another run for EM stocks similar to the run after the great financial crisis or during the mid-2000s?
Potentially we do. We do think that the outbreak of the war at the end of February temporarily disrupted some of the trends that would benefit emerging markets. So, for example, we expected the Fed to cut rates, and we still think they might later in the year or early next year. We expected core inflation measures to begin to trend down and the dollar to continue to weaken. Those are all historical tailwinds for EM performance. At the same time, earnings growth in emerging markets is far faster than international developed markets and even in the U.S., and they trade for a lower multiple. And now add in this idea that investors often mistake AI as being simply a U.S. phenomenon. But when we look at EM index exposures, some of the biggest names, Taiwan Semiconductor, some of the South Korean semiconductor companies, Tencent, Alibaba, are all ingrained in the AI CapEx build-out and infrastructure build-out. So you can continue to lean into the growth of emerging markets. And the good news is you get some diversification while you do that as well, relative to what's been winning in the last decade or so in portfolios.
All right, Michael, that's a good place to leave it. Great to kick off this Friday's show with you. That is Michael Arone. He is Chief Investment Strategist and Managing Director over at State Street Investment Management. And coming up, AI driving the equity markets, and now it's driving trends in real estate as well. A discussion on data center demand and how it's shaping the world of CRE with Lisa DeNight, head of North American Industrial Research over at Newmark.
And then from the land to the skies, Riyadh Air announcing a major operational milestone as it bets big on the U.S. aerospace ecosystem. We're going to discuss all of that with CEO Tony Douglas.
And then from skies to space, major news out today surrounding the long-awaited SpaceX IPO, with the company set to go public in just weeks. We're going to break down what to expect with Eddie Best, co-chair of the capital markets practice at Willkie, Farr, and Gallagher. All that and more coming up. This is The Close on Bloomberg.
President Trump saying today that a final determination on a preliminary deal to extend a ceasefire with Iran is coming. The deal would extend the ceasefire by 60 days, launching further talks on Tehran's nuclear program. Let's bring in Sarah Bianchi, Chief Strategist of International Political Affairs and Public Policy at Evercore ISI. And Sarah, the New York Times reporting that the president left a 2-hour meeting on this possible deal with Iran without making a decision. It's already Friday, unless he announces something on Saturday, which could very well happen. I guess my question is, what's the downside to agreeing to a preliminary deal that pretty much we kind of already know the details of at this point?
Well, I think he likely is going to take the deal, but it does come with downsides. I think there are a lot of folks who say, why is this better than where we were before it started? You know, we have you're giving some concessions before they even agree on anything on the nuclear side, and you know, some economic relief and such. And so I think this has really been the deal that's been in offing for a bit now. And while I do think ultimately he'll take it, I think he's very worried about the criticism that you know, it's weaker than what Obama agreed to. It's doesn't have any enforcement mechanisms. It's not clear what the 60 days looks like. I think that's mostly why he's hesitant.
Okay, so if that's the case, we know that there are a lot of hawkish allies, you know, to the White House, basically pushing him not to accept a deal that resembles in any way President Obama's Iran nuclear deal. So it feels like his options have now become limited to either escalation or humiliation. Is there, you know, some kind of path in between?
Well, I think that he realizes he doesn't have a lot of cards to play. I think the Iranians have been willing to stay tough for leverage, even though this is causing them pain as well. And I think he is very hesitant on escalation. And so I think what he's going to try to do is sell this deal as better than the Obama deal, because ultimately it could have a moratorium on nuclear, on the development of nuclear capabilities and such, rather than small limits. Now, after a certain period of time, it will have that. But I think he is kind of stuck, because he really needs to. It's very hard to leave without the straits being open, so he needs to get that done. So I think ultimately he is going to try and sell this, because I think he understands this deal. You know, the bid ask isn't really going to change in a meaningful way, but he doesn't have a lot of great options.
Well, give us a sense of just how much pressure the president's under right now to come up with any sort of deal. I mean, you think about the fact that, you know, we are approaching primary season. You think about, you know, some of the affordability stats that we're seeing when it comes to energy bills and increasingly grocery bills. I mean, how much of a factor is that playing here?
I don't think there's any question that the president would like to be done with this. I don't think he expected it would take this long. I don't think you know, he wanted to be post-Memorial Day with gas prices like this. So there is pressure. But I think, you know, he has said that the midterms aren't his primary goal. And I actually do think if he thought he stuck around in this thing for a few more weeks and the deal was going to get meaningfully better, he may take that trade. But it doesn't seem to, you know, we've been kind of going around and around, and it doesn't seem to be getting much better. So I think he is better off to go ahead and take something at this point. But certainly his political advisors would like to see nothing more.
Well, talk to us, too, about, you know, you think about the past 3 months of this war. We're closing in on that sort of anniversary here. What has this meant for the U.S. with its relationships, you know, with its allies? You think about the developed world and, you know, how this has all come together. I wonder, you know, what are the lasting potential impacts there?
Well, I don't think anybody would argue it's been particularly good for the United States. Certainly, it has accelerated even more the tensions between the president and the EU. I think certainly allies in the region are frustrated. This has been quite damaging to them economically. You know, there's some sense that he's trying to get them to now do more on Israel. I think that's going to be a bridge too far.
Okay.
And, even the negotiations with China, I think was, he was hopeful they want to be more forward leaning there. But,
Right.
China's got on an economic mission. They're not going to play a starring role in this thing. So I don't think there's anything that anyone would really say that that this has gone particularly well.
Sure. Sarah, one last question before you go. We noticed that Iran is hosting an Iran Project. It's an international exhibition, an investment conference organized by a charitable foundation that's taking place from May 31st to June 1st. Isn't that telling, the fact that this is even taking place?
It's super interesting. I think, look, they are very careful students of the U.S. and the leverage that they believe they have, even though, look, the president's right. I think there has been an awful lot of damage to Iran. And that's why I don't believe there will be a deal that doesn't at least give them some sanction relief or something, because that is what they're going to insist on. But I think they are trying to show they're open to business. They're using this moment in the world. And look, there's still going to be a scenario where within 60 days, he gets a very long moratorium on development, and he'll be able to make the case that he's made a lot of, progress in terms of weakening this regime. That's what he's going to try to be selling. But I think he knows it's an uphill battle, and
so it'll be fascinating to see how it does eventually shake out. Sarah, really great to get some time with you. That is Sarah Bianchi. She is Chief Strategist of International Political Affairs and Public Policy over at Evercore ISI. Now, coming up, commercial real estate seeing a huge shakeup from the AI ecosystem. Discussion with Lisa DeNight of Newmark coming up next. This is The Close. Retro tech company Dell, it's the top mover in the S&P 500 today after issuing blowout results due to the demand for its AI powering servers. And AI demand isn't just fueling the tech sector. Our next guest says that the AI infrastructure build-out is a powerful new demand driver in traditional industrial real estate. Here with us now, I'm pleased to say, is Lisa DeNight. She is Managing Director and Head of North American Industrial Research over at Newmark. Newmark is coming out with a new report on how the data center market will shape CRE overall this year. Lisa, it's great to have you with us. And I mean, my understanding of this report is that, you really try to quantify the halo effect here, and you focus specifically on Texas data centers as sort of a case study. Walk us through what you found.
Yeah, thank you for having me on to tell the industrial real estate growth story here, because the AI infrastructure build-out, historic build-out, I should say, is not just a data center story. Every single data center that is coming online has a supply chain supporting it. And if you think about all of the physical goods, like the tangible goods that need to be produced and distributed to go into building data centers, kitting out data centers, powering data centers, the servers and racks and chips and all that stuff, it requires industrial real estate to support it. And nationally, we saw the data center pipeline grow 400% since 2020, which is really catalyzing industrial real estate demand to support that build out. And you're right, Texas is absolutely where we're seeing it manifest the most, and we can walk through why. But I should say that this is a pretty broad-based story across the industrial market. And we're tracking 280 projects across over 30 states in terms of data centers in particular. So it is broad-based, but Texas is definitely where we're seeing the strongest demand right now.
And of course, with the appetite to build data centers, you get communities that are not on board with everything. At least 69 jurisdictions in the U.S. have enacted temporary or permanent bans, moratoriums on data center construction to protect local resources, whether it's water or power. What's the challenge there to kind of get the community on board with this?
I mean, there are challenges both existing and emerging, and certainly the community pushback is an emerging challenge. I think data center operators and hyperscalers are really trying to figure out how to meet the needs of the community have the technology progress to a point where there's less burden on the water and power infrastructure. But what we are seeing in Texas in particular is this, I'd say, 4 interlocking layers of what I'm describing as a powered industries ecosystem. And in Texas, you have, the, I'd say, easier ability to permit, easier ability to get power, and certainly the people are there to furnish this powered industries ecosystem. So just very quickly, the 4 layers interlocking in this Texas powered industries ecosystem are the data centers themselves, of course, then advanced manufacturing, power capacity, which is huge, and cross-border supply chains. And because Texas really seen all 4 of those at a scale unmatched across North America, that's why it's driving the biggest industrial multiplier demand.
Well, let's talk a little bit about supply chains, because you make the point that supply chains are elongating. So when you think about some of these backlogs, what do they look like at this point? Where are they expected to go?
Well, I mean, it is backlog atop backlog in the data center space right now, and I would extend that to the other elements of this powered industries ecosystem, where advanced manufacturers trying to set up shop to address some of those supply chain backlogs for things like electrical componentry, chips, of course, all the stuff that goes into data centers. There is a definite bottleneck effect throughout these layers of powered industries ecosystem. But Texas is, again, the reason I kind of come back to Texas is that it's rather unique in the scale at which it's able to allow these manufacturers and data center operators to actually meet a timeline that works for them. I mean, Texas has more natural gas capacity underway than the next 7 states combined. Only China has more power capacity from natural gas underway right now. So Texas does help occupiers and hyperscalers meet that timeline need.
Lisa, thank you so much. Lisa DeNight is Managing Director and Head of North American Industrial Research at Newmark. We didn't get a chance to ask her, but data centers in space, that's something that Elon Musk wants to launch.
Those orbital data centers.
I know. You think that's like a 2030 or a 2050 or a 2080 kind of event?
Sooner than you think.
That's at least according to the SpaceX prospectus, right?
Exactly. Yeah, there you go.
All right, coming up, Riyadh Air's U.S. business is taking off after delivering its first aircraft to 2 U.S. states.
We're going to talk to the carrier's big bet on U.S. aerospace with CEO Tony Douglas. That conversation up next. This is The Close. It's just about 3:30 p.m. in New York. This is the countdown to The Close. I'm Katie Greifeld.
And I'm Scarlett Fu. I was going to give you an update on what's going on with the U.S. and Iran and coming up with a peace plan. Well, we're still waiting. The president has not signed off on this interim temporary peace deal, but I don't think the equity market cares one way or another.
No, you take a look at the S&P 500 right now. We're higher by about 0.3%, a kind of lackluster end to it. Has been another strong month in these markets, though I will say maybe as we get closer to 4 p.m. that close, maybe we'll see a little bit of a pickup in activity, window dressing, if you will.
Could very well be, but we've had 7 days of gains. We're going to round off 9 straight weeks of advances. So I think pretty much the equity market has spoken, which is we're moving ahead. Earnings are just fine. So, somehow, somewhere, some kind of resolution will happen in this Iran war.
That is certainly the story in the equity markets right now. We'll see, of course, if that changes, whether or not we get an update from the president on that 2-hour meeting that he had on Iran. But let's turn to the private sector right now, because speaking of geopolitics, Riyadh Air is betting big on the U.S., delivering and inspecting its first Boeing 787-9 Dreamliners to South Carolina and to Washington. Now, this is a historic milestone in the airline's evolution, and it hopes to serve more than 100 destinations worldwide by the end of this decade. Let's bring in Tony Douglas. He is the CEO of Riyadh Air, joining us now. Tony, great to have you with us. So, of course, you're taking these deliveries, but let's talk a little bit about the process to get here, because my understanding is that, you had several delays here, and I wonder, what the path looked like, especially getting these certifications.
Well, first of all, it's great to be with you this afternoon. And for us, this is a great story. You can probably see behind my right shoulder the tail of the Riyadh 787 Dreamliner. And we first signed this deal with Boeing in March of 2023. So just over 3 years ago. So we've worked really well with the incredible Boeing team. And you're right, we're just about to take delivery of not one 787, actually two. And as you mentioned, what's going to happen is one will take off from here, Charleston, South Carolina, early next week. The other one will take off from Seattle. Mm-hmm. We've got it timed so they actually converge over Europe, and then they'll fly in together into Riyadh the following morning. They'll land one after another. And for us, that's a historical moment. It's the establishment of the new national carrier of the Kingdom of Saudi Arabia. And our mandate, as you said, is 100 cities within the first 5 years. It doesn't get any better than that in our line of business.
And Tony, of course, we're talking about those Boeing Dreamliners. You are standing in front of a Boeing building as well. But I want to talk a little bit about Airbus as well, because you're supposed to be taking delivery of A320s this year. That program is delayed. So what is your expectation as it stands right now as to how many Airbus jets you will be receiving this year?
So the Airbus program has currently held solid. We take our first Airbus delivery at the back end of this year. But of course, the first deliveries were always going to be the incredible Boeing 787 Dreamliner. And what's unique behind the product behind me is the cabin. This cabin, in our opinion, is a bit of a game changer. Not only is it the standards that it sets in terms of comfort, quality, we try to bring the elegance and the grace back into commercial air travel. But it's also got a premium economy product in here as well. This premium economy product, we think people are absolutely going to love it. And in all honesty, it's better than many of the business class products out there. So when you see it, when the traveling public see it, I think Riyadh is going to be a big hit. Of course, I would say that, wouldn't I?
Yes.
But this is the biggest startup in our line of business in the Middle East since Emirates. Historical moment. We're super excited, and Boeing have been amazing.
Well, speaking of which, you're launching an airline at potentially the most difficult period for an industry in the region. Rivals in Qatar and the UAE have yet to recover, and capacity in the region has declined overall. How did you prepare for this moment? How are you bracing yourselves for this environment that you're launching in? It's not easy.
In my line of business, I guess it's never been easy. There's always been challenges, be it pandemics, be it volcanic ash crowds, whether it's been geopolitical situations. So I guess in some ways, it's a tough business, and this is a complex undertaking. That said, all the fundamentals for us remain exactly the same as they were when just over 3.5 years ago, we signed this contract with Boeing. We've got 22 cities we want to connect to in the next 9 months. And the minute these incredible 787s land back home in Riyadh, we'll turn them around real quickly, and we'll put them to work.
Tony, you had previously said that you plan to operate 100 destinations within 5 years by 2030. You're about 1.5 years behind your original schedule. So is that achievable?
So the 5 years obviously will start from when we take the first deliveries, which will be next week. It is achievable. It's one of those targets, though, that's a big target. And we're super excited about that because the kingdom needs better connectivity for its citizens to go to many new destinations all around the world. But given the amazing tourism attractions in the Kingdom of Saudi Arabia now, we want to allow everybody to come and enjoy those as well. Expo 2030, big event in the kingdom, and the FIFA World Cup in 2034. So we're going to be busy connecting cities literally from the end of next week.
Well, let's see how, of course, the World Cup in 2026 goes. A lot of hand-wringing about New Jersey Transit. That's a whole different conversation. I do want to talk a little bit about fuel costs and talk a little bit about oil, because certainly the past 3 months that we've seen in energy costs, I'm sure you weren't exactly expecting that as you counted down to your launch here. So how are you handling oil costs? Are you hedging your oil, or how are you approaching it?
I guess you won't speak to any airline executive who won't explain the concern around a rapid increase in fuel costs. It's the biggest single cost to all of our businesses. But I think, as we've always seen before, it fluctuates. We hope that once the conflict is resolved, there is some degree of moderation in the right direction coming down. But interestingly, I'll go back to that premium economy product. What this gives us is a value offering. It's the stepping stone between economy and business class. We think people are going to love this because as ticket prices inevitably go up, this gives actually an alternative proposition. It's super comfortable, extra leg space. It's the first premium economy product as well, right? Which will have sports leisure wear as part of the offering. For many airlines, you might not even see that in business class. We're going to have super fast Wi-Fi on all of our aircraft from day one. We've got the world's most modern in-flight entertainment system. It's called a Strover, super high definition screens, which you can cast your mobile device through the super fast Wi-Fi link to. So all in all, what we're in the market to do is present value. And we think the guest is going to really enjoy this proposition.
All right, Tony. Great to get your take on everything. Thank you so much and good luck to you. Tony Douglas, the CEO of Riyadh Air, joining us from Charleston. Coming up on The Close, shares of Ford are on pace for the best month since the financial crisis. And it's not because of a new car. It's today's stock of the month. Coming up next. This is The Close on Bloomberg. It's time now for our stock of the hour, or should we say stock of the month. We're looking at Ford shares. They're set for their best monthly performance, there we go, since the financial crisis. The automaker's status as a possible beneficiary of the AI boom is sparking an investor frenzy. Bloomberg TV markets correspondent Nora Melinda joins us now. So explain how Ford can be the next AI play.
Yeah, so people are looking for any company that has essentially AI adjacency. So what they're looking at here in particular is Ford's energy business. They're looking at its energy storage industry and whether or not they're able to ramp that up in a way that maybe a competitor like Tesla has. Yeah. So you're seeing this stock really soaring, set for its best month in 17 years. So people are clearly clamoring for any sort of name, any sort of exposure to artificial intelligence that they think could potentially pay off.
Yeah, it's interesting. I mean, we know that Tesla is big in this business already. Ford seemingly taking a page out of their book. What's the expectations as to what other automakers are going to do? Is the expectation that they're going to follow the lead of Tesla and now Ford?
Well, that's the debate. People are curious as to whether or not people are going to be following Tesla and then they're going to be following Ford. We do know that automakers have already had some sort of battery expertise from EV development. Ford, of course, very involved in the EV space. So it's about whether or not they're actually able to supply some of these hyperscalers, which is what Morgan Stanley said earlier in a note. And that's why you're seeing such a strong rally so far this month, because Morgan Stanley was actually talking about the fact that its energy business could potentially be a beneficiary of that AI trade.
Okay, so there's the bullish side. What are investors saying in terms of whether the fundamentals justify all this?
Yeah, and that's also a back and forth, a bit of a debate on Wall Street as to whether or not they think the fundamentals will actually be supportive of it. The stock is relatively cheap in comparison to the broader market, so that is something that's been underscored from those that are on the more bearish side. If you also take a look at some of the short covering, the stock has seen 22.3 million shares. That's about $370 million of short covering over the past 30 days. So you're seeing a lot of those people really maybe trying to get out of the stock, cover those short positions as we're seeing this rally continuing to grow.
And what can we extrapolate out from the month that Ford has had more than 40% higher in May? What does that say about the broader market at this exact moment in time?
Well, I think it just tells us about investor enthusiasm and the idea of artificial intelligence adjacency, and not necessarily relying on some of those semiconductor names or software names, but just any sort of company that could potentially potentially also get a play in the space. And it's just not being just an automaker, but being able to diversify and figure out where you can fit in this AI landscape.
By the way, what is its basic business like? You know, the actual business of selling cars and financing cars to be sold.
I mean, if you take a look at Ford against its competitors, we see the stock is up about 33% year to date. That's compared to GM, that's up about just a little below 3%. So doing decently so far this year.
It's funny, you know, this all kicked off on May 12th after Morgan Stanley came out with a note basically saying their prediction that this energy business could be worth $10 billion and that maybe Ford would soon strike deals with hyperscalers. And then I guess that adds up to a 40% rally.
That's a lot of maybes and ifs.
Yeah, but you know, people ran with it. And at least for May, what a month it was for Ford. That is our markets correspondent, Nora Melinda, breaking it down for us. And coming up, it's the closing bells on this Friday, the final trading day of the week and the month. We're going to take you there with Veronica Willis. She is global investment strategist over at Wells Fargo Investment Institute. That conversation up next. This is The Close. We are just 10 minutes away from the closing bell. Katie Greifeld here with Scarlett Fu. And, you know, pretty mild day overall, but it does look like we're going to finish in the green on this day, on this month.
Yeah, and at a record high for the S&P 500 as well. Currently up a third of 1%. This is the 7th day of gains, and we're looking at a 9th straight week of gains. I believe that is the longest stretch since something like 2023.
Yeah, no, it's been remarkable, certainly. And it's interesting. I mean, the equity market just seems pretty much floating along on this idea that earnings have been fantastic, and that's good enough for them. But then you think about what we're seeing when it comes to the bond market, when it comes to oil, it's a slightly different story.
Yeah, but for equities, it's like, oh, whatever will be, will be. You know, it'll all work itself out, and they're kind of looking ahead to that. And it feels like the bond market, at least for now, is making some peace with the idea that Iran's not going to be resolved anytime soon, even if there is some kind of tentative peace plan that's agreed to.
Absolutely, and maybe we'll get some details on that in the hours ahead. But for now, let's talk a little bit about these markets as we count down to the close. Joining us on set is Veronica Willis. She is global investment strategist over at Wells Fargo Investment Institute. Veronica, great to have you with us. And you think about, you know, some of the superlatives that Scarlett just mentioned. I mean, when it comes to the daily win streak, when it comes to the weekly win streak, how much good news is priced into this market at this point, and is that justified?
Yeah, I think what we're seeing right now is the market is optimistic, but it's not running just only on optimism. So that really great earnings season we're wrapping up is priced into the market. And I think the market has priced in a continuation of that for the next quarter of earnings. And so if we see any kind of disappointment for the next quarter of earnings, that's going to be a little bit of a volatility shock for the markets. But I think that that's something that's already being priced in right now.
Interesting. So, you know, we'll see what the next earnings season holds. But in the meantime, I mean, you think about all the geopolitical question marks percolating right now. Again, waiting to hear more details from President Donald Trump on how that 2-hour meeting on Iran actually went. It seems like geopolitical headlines, they haven't made much of a dent in the equity market for several weeks now. I mean, as we wait for that next catalyst from corporate America, do you think that that's going to reassert itself as a driver?
Yes, I think as earnings from last quarter start to fade into the background, the market's going to start to pay a little bit closer attention to some of the geopolitics again. And so any of these developments that we get, whether it's an extended ceasefire, whether there's some kind of escalation, those are also going to be some catalysts for market volatility. I think the market is wanting that ceasefire right now. The bond market wants that ceasefire right now. As you mentioned, it's starting to get a little bit more comfortable with that already. And so we'll have to see what happens later today. But I think that that's what the market's going to be paying attention to going forward.
In terms of where you want to be within equities, your take is to trim energy stocks and commodities and rebalance towards IT and equities. Is there anyone here who doesn't have too much IT in their portfolio? It feels like there's a lot of concentration risk if you look at equities, and also increasingly if you look at credit too.
Yeah, I think what we did earlier this year after that pullback in tech, we were neutral, and now we're saying, hey, be a little bit overweight in tech. And so take some of those gains that you might have gotten from energy because of what was happening in Iran and put those proceeds into the tech sector. So we're not wanting investors to get too overweight in tech, but holding a little bit more in tech, if you can get it on some of the pullbacks, is a really good idea. You might not be able to get that timing now with what's happened with tech, but don't rebalance at this point if you want to kind of let that tech float a little bit.
Okay, well, within tech, there's chip makers, which have been on a tear. Certainly the memory chip makers have done so. And then you've got hardware, like Dell, for instance, have done phenomenally well. And even software has made a bit of a comeback, up 20% from their recent lows. So where do you want to be within those segments of technology?
Yeah, I think having that diversified exposure within technology is a really good idea right now, because we're not really wanting investors to try to pick and choose the exact winners within the sector. I think with the AI story, it's really interesting to play that with tech. We've talked about it before, to think about some of the other sectors as well that are going to benefit from the AI trade. So thinking about things like utilities, thinking about industrials as well as a way to play that AI trade. And it holds true for tech as well. You don't need to pick one of those subsectors within tech. The whole sector is going to benefit.
Interesting. Are there any sectors, that you would de-emphasize at this moment? You think about the AI trade, it seems like, it's spreading far and wide here, but you think about some of the cross currents that we've been discussing in the broader economy. Of course, question marks over, inflation, price pressures, how long this consumer can remain resilient. I mean, how do you sort of work that into a portfolio?
Yeah, so right now, we don't really like those consumer-driven sectors because we're concerned about inflation right now. We're concerned about where prices are, and it hasn't hit the consumer completely yet, but there's going to be a point where it's going to stall spending. And so, consumer discretionary, consumer staples, those are the sectors that we're wanting investors to avoid in favor of some of the sectors that we like better right now.
There was a story on the Bloomberg earlier about how there's still this dash for cash. Money market assets have now swelled to $8.3 trillion. They were already at records, but they're at a bigger record. $8.3 trillion is a lot of dry powder. Do you think of it as dry powder, or are investors just content to let it sit there in cash?
I think there's a combination. I think some of that is dry powder, but I think some of that is a shift in the way that people are saving. And so with that increase in rates that we saw in 2022, people have kind of shifted from a traditional type of savings account, and they might be using those money market accounts for saving. And so I think there's a portion of all of those funds that are in money market accounts that people are thinking of as their savings. And then there's going to be that portion that people are thinking of as dry powder.
Yeah, absolutely. It does feel like something structural has maybe changed with how people are approaching money market funds. Let's talk a little bit about the bond market proper, though, because I actually filled in on Real Yield today. It's a Scarlet Fu property there, but it seems like duration has been a dirty word for a long time now, and I wonder when the longer end of the yield curve is maybe going to look a little bit more attractive.
Yeah, I think what we're looking for there is a little bit more clarity about the situation in Iran. So I think that the geopolitics are impacting that longer end of the curve a lot more. We've seen those rates spike a lot higher. But I think what's good from a long-term investing standpoint, if you are an investor that's an income objective and you're thinking about those bonds from the income component, long-term is not a bad place to be to lock in those higher yields. And that's if you're not worried about what's happening with that kind of price appreciation and those movements, because you're more concerned about getting that 5% yield that you might be able to get on the 30-year.
Absolutely. Veronica, great to count down to the bells with you. That is Veronica Willis. She is Global Investment Strategist over at Wells Fargo Investment Institute. We missed you on Real Yield today.
I know. I'm sorry. I had to. We are rehearsing for a new show, so my attention was divided. So we're going to talk about all of that on the new show coming up, which will be unveiled next Friday. 7
short days. You, Tom Keene, talking personal finance. I truly cannot wait.
Yeah, Bloomberg Money will launch next week, but we'll get into all of that, which is why the whole $8.3 trillion in money market funds was intriguing.
There you go. Well, for the time being, we're getting closer to the closing bell. Our simulcast starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Katie Greifeld and Scarlet Fu, she's in for Romaine Bosick, here to help take us through the closing bell. It's a global simulcast. We're joined now by Tim Stanovic.
What did you guys do with Romaine?
I don't know where he is. We asked him where he was going. He did not get an answer. Carol Massar isn't here either.
Maybe they went on vacation without us.
That's
you know
so
what?
sweet.
We don't need to know. We're happy to be here in their stead. I will try not to embarrass the company here as we do our stellar simulcast.
Well, I like to imagine they're both watching fondly right now. And let's talk a little bit about today, Tim, because it looks like we're going to finish in the green on this Friday. We're looking at gains of about 5% for the month of May.
Yeah, it's just wild to look back at the last 9 weeks on the S&P 500. I'm going to go through some of these as my gainers later, but the numbers that we're seeing in today's trade are kind of mind-boggling. I mean, we'll leave Dell out of the conversation, but double-digit gains for NetApp, ServiceNow, IBM, Hewlett-Packard Enterprise, Workday, Supermicro, Robinhood, and Oracle. You know, 10 stocks in the S&P 500 up more than 10% today. It's crazy.
I mean, I'm looking at the fact that we have these headlines crossing the terminal. The president has left a meeting with his top officials. 2 hours, no deal, and still the markets are green. You know, the markets are still bullish on some sort of a deal happening despite all evidence to the contrary. So that's what I'm tracking. Yet again, another day here on a Friday.
All they need to hear is there's some kind of AI connection, and that brings me to Ford. Ford is up for a 9th straight day. No, 8th straight day, but at this point, who's counting? The stock up another 5%. It's the next AI play, Katie.
Yeah, it's pretty amazing to see that AI sort of wrecking ball roll around the markets, and these different names certainly has shined upon Ford. Let's talk about where we're going to close out on this Friday, the final trading day of May. The S&P 500 looks like we're going to finish about 0.2% higher, just shy of 7,600 on the S&P 500. The Nasdaq higher by about 0.2% as well. The Dow Jones leading the charge here, but again, it's price weighted, so who knows? You take a look at the little guys. The Russell 2000 actually sitting this rally out, declining a little bit on the day, but overall, another positive day on Wall Street, Tim.
Even though the S&P 500 was higher and there were some notable names and some big names that moved higher, again, market cap weighted index. So this is the one we look at, Scarlett. You had only 200 stocks roughly move higher in the S&P today, about 300 move lower. So you had more decliners than gainers, even though it was in the green.
And I love that you brought that up because you set up the IMAP perfectly. When you look at these S&P 500 split into 11 industry groups, there's only 2 sectors that finished in the green. Tech, which is, of course, the biggest weight in the S&P 500, up almost 2%. Financials up 0.5%. Everything else, 9 sectors, including the smallest ones, all finishing in the red. For the month, it's a similar story. Only 3 sectors finishing in the green, with tech up 16% for the month of May, and that has lifted the S&P 500 to a 5.2% advance for the month.
Oh, and Scarlett, you set me up perfectly for my tech-focused gainers
it's like we
today.
planned this.
All right, you two.
All right, look at this. Well, you know, we do host a show together on Tuesdays at noon that
What's that
everybody
called?
should tune into. It's called Bloomberg Crypto.
Oh.
Dell Technologies shares. Can you believe this today, guys?
I literally cannot.
33% to the upside. The stock is up more than 200% this year. We know the story by now. Shares surged after the company gave an outlook for annual sales that far surpassed analyst estimates. The demand for servers that power AI revenue in the fiscal year ending January of 2027 will be about $167 billion, including $60 billion from the sale of AI servers. That tops analysts' average estimate of $142.1 billion. I also wanted to take a look at what shares of Micron did today. They rose in the session up more than 5%. This after Susquehanna raised its price target to a street high view of $1,750. That was from $600. It's at $971 right now. So we were all talking about the view of UBS earlier this week, and that helped propel Micron to $1 trillion market cap. Well, this takes out what had been that street high from earlier this week. That was on Tuesday,
Amazing.
I believe. And shares of Micron up more than 5%. Also, another gainer in the S&P 500. This one, I believe, is the second best performer. NetApp. This rallied today, 22.4%. The data storage provider reported its latest earnings. Analysts said the report is a strong print from the company, showing strong growth with upgrades to consensus expected.
And I have great news, actually. We're going to be speaking to the CEO on the close at about 4:20 p.m. today. So
funny how that works. I just set you up perfectly for that.
Incredible. Again, like we planned this.
Yeah.
Amazing.
We're so good.
Yeah.
All right, Christina, this is where you take away the
Tim,
cringe.
I feel so left
the
out.
three of us.
All right, I'm Debbie Downer today. My job is decliners, and I want to start with one that was unexpected, and that's Costco. You know, it's down. It's at about 4% now. It was as much as 5% earlier today. The company reported actually higher than expected earnings, but it wasn't enough apparently to impress investors. But hey, those investors could end up happy anyway soon because there's rumors of a potential special dividend coming in the coming months. So that, of course, could spark a rally of those Costco stocks. So stand by and have faith, Tim, in that $1.50 hot dog.
I'm all about the peanut butter pretzels at Costco.
Of
but
course
I
you are.
Ooh.
All right. The other one I'm looking at is Eli Lilly has had a bit of a ride today. It's down as much as 2% at one point. This comes after this back and forth with CVS. You know, the drug giant and prescription plan giant provider was going to restrict access to Lilly's obesity shot Zepbound. But Lilly agreed to cut the prices it charges many of those health plans under the CVS umbrella. And that decision by CVS was reversed. And again, still uncertainty. That combined with uncertainty over the Trump administration's import drug policy seems to be putting the stock a bit on a back foot. It's especially problematic in light of this most favored nation status. It could complicate Eli Lilly's ability to do drug rollouts in places like Japan and elsewhere. And then finally, we are falling into the gap. We are back to the gap, Tim. We've talked about the gap already today. Really down as much as 17% earlier today on a weak sales outlook. Parts of that portfolio have been struggling for a while, but until now, Old Navy had kind of been the light that was carrying the rest of that portfolio. Old Navy reported a bad earnings, and so you saw that stock kind of tumble despite the fact that some of the other sectors, including Gap, were doing a bit better during this reporting sector. So I don't know if you guys are wearing Old Navy or Gap or Athleta.
No. I mean, the Gap I thought would do pretty well because of that collaboration with celebrity designers, including Victoria Beckham, which apparently sold out and did really well.
Agreed. There was something I wanted for a couple different drops, and they were all done. So I was like, oh, Gap will be doing great. But ironically, yeah, Old Navy apparently lagging and pulling the rest of it down.
Yeah, pretty interesting there. I also really like Athleta, but I feel like I might be alone in that because athleisure isn't hot anymore. But anyway, terrible day for Gap. Let's talk a little bit about what happened in fixed income land in the Treasury market. Very quiet overall. As you can see, we're talking about very, very slight declines when it comes to the yield picture. When it comes to 30-year yields, maybe moving up a hair. But I think I'm going to go ahead and call that unchanged, Tim.
All right. Well, not unchanged is the wealth of some of the founders, or I should say the founders of Anthropic, because that latest funding round has now given Dario and Daniela Amade, the founders, co-founders of this company, they own less than 1% of Anthropic. They're now worth $8 billion. So now this latest funding round, they're worth $8 billion each, has added the company's 7 founders to the ranks of the world's 500 richest people. It's the most from one company to be added in a single day in a Bloomberg Billionaires Index history. They all own less than 1% of the company, but now this round of funding that we've been talking about all day, they raised $65 billion at a valuation of close to $1 trillion. You now got all those founders as part of the Bloomberg Billionaires Index.
I feel like we should point out that Dario and Daniela are siblings, which is amazing. And
their parents must be so proud.
I was going to say, do you think
I'm going to have a long talk with my brother and how
he
has failed me in my evaluation and elevation to the billionaires list?
I didn't think you were going to go there, Katie. I thought you were going to go to Jack Clark.
No.
Do you know that he was a former technology reporter for Bloomberg News?
I didn't know that.
And now he's a billionaire, founder of Anthropic.
There's hope for all of us.
Those people who work for Anthropic and are getting equity, they're all going to come out of this doing pretty well. So
yeah, they're going to be fine.
That's why.
All right, what do you guys got?
Much pursued job. All right, in terms of the story we have, it's kind of tied to this, which is Anthropic and all the other large language models are making the traditional rite of passage for college students to get internships very difficult because a lot of the businesses, small businesses in particular, that used to bring on interns to learn the tricks of the trade are no longer doing that. They're basically relying on AI instead to perform the tasks that they used to hand off to interns. So now the few places that do offer internships, it's incredibly competitive. So Katie, I know your child hasn't been born yet, but you better start signing her up for internships.
You know, the way I'm thinking about it, I just hope by the time that, you know, I've produced this child and she turns 18 or something, that the higher education landscape, we're going to figure it out. We're going to sort through all of this AI turnover and existential dread, and maybe everything will be fine. Tim, how do you feel?
Did you not think Katie had enough stress in her life right now. We want to add that on top of everything else she's been thinking about.
I shouldn't have said that, but as a mother, that's where your mind goes.
Yeah, no, it is pretty, I don't know, dire. And it does fit into this broader conversation we've been having about, what is the impact of AI going to be in the workforce, whether or not you're going to see sort of a hollowing out, and what the pipeline for some of those higher ranking roles looks like if you do have AI replacing a lot of these entry-level jobs.
I expect a full report on Monday after this weekend, and we can all spend the weekend thinking about it and figuring it out.
Wonderful.
All right, have a great weekend, everybody.
You too.
That is going to do it for our cross-platform coverage, the end of a holiday-shortened trading week. But don't worry, we will all be back. Well, I guess maybe a few of us will be back on Monday, same time.
It was a long, short week.
Fun. I will be off.
This is Bloomberg.
Now coming up, a look at one of the biggest gainers on the day, why shares of NetApp are soaring following its quarterly report. We'll discuss with the CEO next hour. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld. Let's take a look at where markets closed out on the day on this Friday. Thank goodness. The S&P 500 finishing about 0.2% higher. A very quiet day overall. You take a look at what happened in the bond market. Not much. 10-year Treasury yields down by about 1 basis point. So you did see a little bit of volatility continue to drain out of the equity market as measured by the VIX, down by about 4/10 of a vol point. I don't know why I led myself there. Anyway, the VIX is trading with a 15 handle. And Brent, keep an eye on Brent, now trading at $92 a barrel, getting closer to that $90 threshold. Let's take a look at some of the day's biggest movers. A lot of earnings stories here. We were just talking about Gap with our radio friends. Gap having a terrible day. Its worst day in a year, down 15% post earnings. A different story when you take a look at the other two names that I have on this board. NetApp soaring by 22%. We'll be speaking with the CEO in a few minutes' time. And Dell also having a fantastic day, higher by about 33%. Let's talk a little bit about ETFs because it's time for our weekly ETF wrap. And we take a look at sort of the active revolution that we're seeing in the ETF industry. We talk about it all the time when it comes to flows, but let's talk about it from the issuer perspective. This is really interesting. You have a lot of the 90s active stars sort of really making themselves known in the ETF space. Taking a look at Capital Group, for example, 5 years ago, they were the 141st largest ETF issuer. Now today, they rank at 11. And it's a similar story when you take a look at Fidelity, T. Rowe, JP Morgan, and Dimensional. The list goes on. Let's bring in the man who sort of crunched the numbers for us. His name is Eric Balchunas. He is an ETF analyst over at Bloomberg Intelligence. And Eric, you talked about this sort of as the empire strikes back, that these big mutual fund titans really coming in and rising up the ranks in the ETF world as well.
Yeah, look, I mean, this industry has been really, really nervous about active for the last 15 years. Is active dead? What's going to happen? Especially active mutual funds, right? And a lot of these firms were hesitant to get into the ETF space. They didn't want to show their holdings every day. They were reluctant to do that. But a couple of them dipped their toes in the water. Capital Group in particular decided to do daily transparency. And many of them decided to sort of bite the bullet and cut their fees, or at least give most ETFs the institutional class fee that the mutual funds have. And this really changed the whole dynamic. Once they did that, once they sort of got on the ETF industry's terms and not their own, they all took off. And you can see they're climbing up the ranks. These active mutual fund companies are, amongst the top 15, top 20 now, and they're going to keep going. JP Morgan has a real shot to be fifth soon. Dimensional is seventh. These are big boy assets, right? So it is coming a little bit at the expense of their mutual funds, but it's better than not doing that, right? It's better to save some clients than lose them all.
Well, let's talk about that a little bit more. I mean, you said that you'd think about their mutual funds. This hasn't exactly helped what they're seeing there. And what they've been seeing there largely, Eric, is a whole ton of outflows.
Yeah, I mean, Capital Group in particular, I mean, we're talking about $400 billion in outflows over the past 5 years. That's a lot of money. That doesn't make up for their ETF inflows. But again, 115 billion into the ETFs, you'd rather have that. So a lot of these firms are just trying to make some kind of stake in the ETF world. And it's hard. Look, this is the Vanguard effect. I wrote a whole book on this because it's that massive. Vanguard came in and kind of did what Amazon did to the retail world. It just really disrupted the whole thing. So these firms are trying to make do with it, and they are finally getting traction. Franklin is another one. T. Rowe is another one. Fidelity is probably in the best shape, but a lot of those mutual fund inflows are into their zero and low cost index funds, ironically. And JP Morgan is probably the best off because they actually see legit flows into their active mutual funds, and they just passed T. Rowe to be the fourth biggest active shop overall. They're probably the one to watch out in terms of being the sort of like new king of active in 5 or 10 years.
Yeah, JP Morgan, very interesting case, as you point out, the fact that they have seen inflows into both their active ETFs and their mutual funds, certainly a rare breed there. But, I opened the segment talking about how your chart shows that you've seen a lot of these, legacy active managers really climb the ranks when it comes to the ETF league table. But still, you think about their overall share of the market. This is still an industry that is just absolutely dominated by the likes of BlackRock and Vanguard.
Yeah, let me blow everybody's mind real quick, okay?
Please.
So Capital Group takes in $115 billion in their first 5 years. Every month they've seen inflows into their ETFs. I think 20 of their 25 ETFs are over $1 billion. You couldn't have drawn up a better success for your first 5 years, and they still aren't at 1% market share. That is how big BlackRock and Vanguard are. They each have 30%. JP Morgan, who I just said is even in better shape than Capital Group, is barely at 2% market share. So this industry is so dominant. That's why we call them the big two. You could say the big three if you added State Street, but really it's the big two at this point. And they're going to be going at it for a while. But it does give you some idea of this tiny size of some of these new issuers, even though they're that big. That said, they have one ace up the sleeve: ETF share classes of mutual funds. And then just in general, all the lump of money in the mutual funds, 20 trillion, that slowly moves over, could give them sort of like an extra lift up the leaderboard that other people don't have.
All right, Eric, great to get some time with you. Have a wonderful weekend when you get there. That is Eric Balchunas of Bloomberg Intelligence, also my co-host on ETF IQ, the TV show. We're live on Mondays at noon. Scarlet Fu is there, too. It's a great time. But in the meantime, you can read my weekly ETF IQ newsletter that comes out on Fridays. You can subscribe at Bloomberg.com/ETFIQ newsletter. Now, coming up, NetApp surging after its latest earnings report. CEO George Kurian, he joins us next on the back of that print. This is The Close on Bloomberg. Shares of NetApp closing the day well in the green and then some popping after its latest earnings data. The data storage company reporting strong growth and a 2027 adjusted EPS forecast that handily beat estimates. Joining us now to discuss is George Kurian. He is the CEO over at NetApp. George, great to have you with us. And let's get into some of these numbers, because you think about your 2027 sales guidance, it's well above that of industry growth. And I would love to hear a little bit about what is driving that, how much of that pricing is driven specifically by some of your storage gear.
Thank you for having me, Katie. NetApp is a technology company that builds critical data infrastructure for AI. As enterprises start to use AI, they have realized that they need their data well organized so that the models that they use generate accurate results. And a big part of our acceleration in the second half of this year, as well as our outlook for next year, is powered by the strength of our position, both in public cloud and in AI.
Well, let's talk about the cloud a little bit, because that's where a lot of the buzz on AI has been. You mentioned that, you have enterprise customers. That's the bulk of your customers. Where are they when it comes to on-premise AI adoption? What are you seeing there?
We saw strong growth this past year. In our earnings report yesterday, we said that a year ago, for the full year, we saw 400 enterprise large transactions tied to AI. We saw in the fourth quarter of this past year, 500 and a full year number of 1,100. So clearly an accelerating pace of large enterprise AI adoption.
And I'm curious, you think about some of those wins that you just called out, 500, for example, in the fourth quarter specifically. I mean, how much was that driving the revenue guide? If you could give us a little bit more detail there.
Yeah, we reported results well above the high end of our guidance range, as well as earnings well above the high end of our guidance range. And the strength of those numbers were driven by the fact that we saw momentum accelerating through the year. And this confidence in our business has also allowed us to guide this coming year, fiscal year 27, at a higher revenue and EPS than the consensus estimates.
And George, I want to talk a little bit about some of the concerns in the space overall, because there is some worries that what we're seeing is too much too soon, that, the pent-up demand that we're seeing, maybe it's similar to what we saw in the COVID era when it comes to purchasing. And I wonder, do you have any concerns about overcapacity? What conversations have sounded like around that topic?
So far, the demand for AI compute and data infrastructure is well ahead of what we are fulfilling. And that is, work that we're doing with our suppliers to make more supply available. Clearly, you've got to see ROI, return on investment from these capital expenditures. Within the enterprise, we have seen the ramp of AI be more gradual. We said 2 years ago that we saw calendar year 26 be the place where AI would start to pick up in the enterprise, and so far it's playing out that way.
And George, it's interesting. It feels like, the past several years, AI has been the defining story. And, in your time at NetApp, I wonder how that's sort of changed things for you. You think about some of the numbers that you're anticipating for the year ahead. How are the dynamics different from, the past several years for NetApp? How have things changed as we confront this moment?
We've always been in the data business. And I think our view has been data is essential to AI. What we saw in the early build out, post ChatGPT becoming such a viral phenomenon, was compute got built out because you needed the algorithms or the models to get better. Now that they are in a place where they can actually do a lot of work, you need the data part to become much more up to date so that you can make the models get accurate results. And that's where we see the next leg of our growth being poised to happen.
Well, you take a look again at your share performance today. NetApp shares higher by 22% on the day, sitting at a record high. Really fantastic to talk to you on the heels of this earnings report. That is George Kurian. He is the CEO over at NetApp. Meanwhile, let's take a look at how markets closed out on the week. It is Friday. It is the final trading day of the week and of the month of May. Another strong month. You take a look at the weekly performance there. The S&P 500 going to finish about 1.4% higher. A lot of that strength coming through specifically in the tech sector as we got through some of these software earnings. There was a lot of agita heading into this week about what we were going to hear from some of these software companies after the past several months that we've had in that space, the SaaS apocalypse, if you will. But you can see that the NASDAQ 100 finishing out the week with a gain of nearly 3% here. And then you take a look at the 12-year yield, or the 10-year yield. It probably helps that you had a rally of about 12 basis points there, bringing yields down to about 4.43%. And Brent behaving as well, declining by about 11% on the week. Now, coming up, SpaceX is said to cut its target valuation. We're going to discuss with Edward Best. He is the co-chair of the capital markets practice over at Willkie, Farr, and Gallagher. That conversation coming up next. This is The Close on Bloomberg. Bloomberg reporting that SpaceX is reportedly now targeting an IPO valuation of at least $1.8 trillion. That is actually down from an initial estimate of more than $2 trillion. But even so, it's still on track to be the biggest IPO in history. So let's talk a little bit more about it with Eddie Best. He is co-chair of the capital markets practice over at Willkie, Farr, and Gallagher. Eddie, great to have you back with us. So we finally have the public S1, and I would just love to hear your reaction to it because, of course, it doesn't have pricing information, but we got a little bit of details, a little peek at the actual numbers here, and, of course, how this entire thing is structured.
Right. So this is certainly the first time that we've seen all the numbers, and especially the combined numbers with XAI. And I think people have been really looking forward to seeing it. One of the things that we've seen is that the Starlink business is incredibly attractive. It's very high growth. It's profitable. The rocket business is doing quite well. XAI obviously is a great business, but it soaks up an awful lot of cash. So it's interesting to now finally see the combined company. And we've learned an awful lot of things from the about 300-page prospectus that they filed.
Yeah, it's funny. I was talking about it with my colleague Matt Levine, and you know the read of it is that okay, the satellite part of the business makes money, and then the AI part of the business burns money. But let's talk a little bit about some of the corporate governance here, because SpaceX. It's going to have 3 classes of stock. Elon Musk is going to own approximately 85% of the voting control, which is a big number, Eddie. And I wonder, you know, for some of the founders who are still, you know, helming their private companies, thinking about coming forward into the public markets, whether or not, you know, this could inspire sort of a wave of similar structures.
So I think it certainly can. There are an awful lot of founders who don't like the idea of taking their company public and losing control, whether it's absolute control or at least majority control. We've certainly seen companies go public. For example, you know, Google, Meta went public with high vote stocks, so their founders retain substantial control over the company. But this certainly shows that you can have a public company with a founder who can continue on, and he really is not just the face of the company, but he's really the brains and the heart of the company. And I think while it's a great business, a lot of people are going to invest because it's Elon Musk, and this is going to give them some comfort that he's going to be there for a while. He's going to be fully invested in his time. And while corporate governance people may look askance at somebody owning that much of it, this really is very much an Elon Musk company, and people want to make sure he's there and fully invested.
Yeah, that Elon Musk premium, certainly it's been a big benefit to Tesla's valuation, and it looks like the valuation of SpaceX as well. But again, you think about sort of how this is structured, these different share classes. My understanding is that, you know, if you're a regular shareholder in SpaceX, it's going to be an uphill battle to try and actually bring a lawsuit against this company and make your view known.
That's right. It's a unique feature of Texas law, and as you know, SpaceX is now part of Texas, is now a Texas corporation, and as under the Texas corporation law, SpaceX has decided that they're going to only have shareholders be able to bring a derivative suit if they've got 3% of the company stock, which, given their valuation, we're talking about an awfully large number.
And Eddie, we were talking about the Elon Musk premium. Let's talk a little bit more about the Elon Musk universe overall, because, you know, we mentioned XAI, that, of course, merged with SpaceX. Now you have both under one roof. There's been a lot of speculation about whether or not after we get through this IPO, whether or not we're going to see Tesla brought into the fold as well, whether or not we could see Tesla actually merge with SpaceX. And, you know, from your chair, I would love to hear your thoughts on what that would even look like. How would that work?
So there's an awful lot of speculation. There are some people that think that the Class C shares, which none are outstanding right now, they would be no vote stock, were put in there to help with the Tesla merger. I don't think that's really the case, because the Tesla shareholders would want voting stock and trading stock. But it's certainly a possibility. It would be a massive, massive merger, because you've got a company with $1.5 billion in market cap and another company with close to $2 billion in market cap. So it'd be kind of a merger of equals. It'd have to be approved by the boards. It would have to be approved by the shareholders. At the SpaceX side, you've got Elon Musk who can approve it. On the Tesla side, he only has about 30% of the vote, so you still need a significant percentage of the other shareholders to do it. And then really the question comes down to valuation. What are the companies worth? Does it make sense to put them together? What's the business case for trying to put the two companies together? Doesn't mean it's a bad idea, but really the question is, are the companies better off together or are the companies better off separately?
Absolutely. Well, it's some big questions that you laid out there. It's going to be fun to see whether or not we start to get some answers in the months ahead. Eddie, always great to speak with you. Have a wonderful weekend. That is Eddie Best. He is co-chair of the capital markets practice over at Willkie, Farr, and Gallagher. Meanwhile, keeping the conversation going, our next guest writes that as Musk's history has long shown, it might only take an ill-advised social media post or a public squabble with President Donald Trump for SpaceX's price to get cut by a third or more. Well, that still wouldn't be a bargain. It would be enough to entice the masses to take a flyer on a dominant space launch company that comes bundled with exposure to the future of AI. Jonathan Levin of Bloomberg Opinion wrote that, and he joins us now. And Jonathan specifically write, fight the SpaceX FOMO. You'll be glad that you did. Do you think that folks are actually going to take your advice?
I don't know. You know, I mean, the FOMO around this offer is really extraordinary. I run into people like working on public transportation on the way into the office, and they see me like working on my Bloomberg terminal on the laptop, and they all want to talk about SpaceX. It's kind of bananas. It's like you know you're in a cultural moment when you go through something like that. But I really hope that people will be very careful about thinking about the entrance point on this particular stock, because obviously they're talking about coming out at an extraordinary valuation. We're now talking about a 1.8 trillion as opposed to the 2 trillion before, but it's still probably going to be the priciest stock. It's pricier than anything on the S&P 500 by a price. On a price sales basis. And so, with all the speculation that goes into the AI business, and with all that needs to come true for it to sort of grow into that valuation, why not wait a little bit to see what happens, knowing how volatile Tesla has been under Elon's stewardship?
Well, a few things there, Jonathan. First of all, I'm impressed that, you're really seriously working on your way into the office, because I, for one, am probably doom scrolling. But, when it comes to sort of resisting the temptation here, for a lot of investors, that's not necessarily going to be an option when you think about the fact that a lot of these index companies are fast tracking these IPOs, these mega IPOs, including SpaceX, to get into the index faster than they normally would.
Yeah, maybe that changes the dynamics a little bit, but on the other side of it, I think we have the history, really starting with the Facebook IPO in 2012. The hype around these mega IPOs ends up being so extraordinary, and the early investors end up getting such extraordinary valuations on these things that by the time they finally hit the market, I have to say that more often than not, they have ended up being duds. Even starting with Facebook back in 2012, you'll recall that before it really got going, it was dead in the water for about a year there. We've been followed by really big offerings recently by the likes of Airbnb, Uber came out. None of these things have been great compared to the market itself. And I think part of that is just all of this hype that goes on in the private markets, and like all of the early gains have been made by the folks that get in early.
Yeah, it's worth pointing out that, SpaceX, this company is decades old at this point. But, as with any Elon Musk company, when you're buying it, you're buying Elon Musk's vision of the future, his ambition for, what he wants that future to look like. When it comes to SpaceX, we know that includes the galaxy. We know that includes orbital data centers. And it's kind of amazing to think about what they listed as their total addressable market, $28.5 trillion. Would love to hear your thoughts on that.
Yeah, okay, so TAMs are always a little bit of a fairy tale, but this one takes it to a whole new level. I think, as you break that down, the biggest chunk of how they get to the 28.5 trillion is really using their imagination on where artificial intelligence could go. And within artificial intelligence, the biggest opportunity, as they see it, is in enterprise, right? Selling to companies, selling to governments. And as I think through how SpaceX gets to that and justifies, a sales or profit level that would allow them to grow into these wild valuations, what Elon really needs to be doing here is making peace with the corporate sector, making peace with government, and all of the concerns around the neutrality of Grok, all of these these Elon posts where he talks about or alludes to intervening in Grok's outputs. I think that these can really potentially be problematic for the growth of that enterprise AI segment that is going to be all important if they're ever going to grow into these numbers.
Absolutely. Well, Jonathan, for better or worse, we are counting down to that public offering, just weeks away potentially from that SpaceX IPO. That is Jonathan Levin of Bloomberg Opinion. Now, coming up, the summer movie season is officially upon us. Stacy Spikes, he is the CEO of MoviePass. He joins us next to discuss the upcoming slate at the box office. This is The Close on Bloomberg. Hollywood is getting its mojo back. Analysts over at Bloomberg Intelligence projecting this summer's box office can reach a post-COVID high, hauling in more than $4 billion in ticket sales in the U.S. and in Canada. Stacy Spikes, he is the CEO of MoviePass. He joins us now to discuss. So has it started? Can we call this the summer box office already, or do we have to wait a little bit?
Memorial Day kicks off summer box office season, so we're in it.
Fair enough. So $4 billion, that is the projection over at Bloomberg Intelligence. What are you expecting from this season when it comes to the box office?
So 2019 was the highest in history, and so we're about $1 billion off of that for the whole season. So May just had the highest since COVID, which we had $1 billion May. So that's incredible. So we're on track to get all the way back to top levels.
Interesting. I mean, let's talk through some of the comps because, when I was thinking about the box office and some of the potential comparisons there, I went back to Barbenheimer. I mean, that was huge. I believe that was in the summer. If I think back to what I wore to the Barbie movie, what do we have coming up this summer that could potentially rival that?
They're thinking Michael might reach $1 billion, so that's huge. It's only $100 million away from that. You have a Spielberg film coming, which is expected to be really big. You just had Star Wars with Mandalorian hit $100 million this weekend.
Yeah.
So it's cooking.
Yeah. Well, talk to us a little bit about Star Wars. You mentioned that total that it brought in. I mean, what are your expectations overall? I mean, anytime a Star Wars movie comes out, there's a lot of speculation, but what's your take?
It already is going to have a really big drop this weekend, which is unfortunate. So the reviews came in soft. A lot of people said it was an extension of the TV show. So it's not going to do what I think Disney would hope it would have done.
Interesting. And it is funny. I mean, you think about how it feels like we've been building up for years and years post-COVID. You mentioned 2019, of course, the fantastic numbers that we got here. I mean, I wonder what you make of the trajectory that we've seen with some of these box office levels, building upon each other. Why it's taken that specific shape?
If you look at the wave pattern, there's young people going, and then there's a lot of older people after COVID that kind of dropped off. What's beautiful about this is it's a lot of young people. So that wave's going to make a much bigger, longer wave. So that's really driving the market. And you're finally getting, after the strikes and COVID, you're getting the content finally making it to market, because it takes 5 years sometimes to get movies to market. So you're really seeing the pipeline fill up. and everything's starting to hit on all pistons.
Yeah, it's a good point. It feels like when it comes to the actual content, the actual movies that are coming out, it's pretty compelling, these offerings. And we're talking about the summer box office, but then you look ahead to the end of the year. We do have some big expected blockbusters coming through. I'm thinking about Dune 3, for example. We were last talking before the Oscars, and Timothée Chalamet went home empty-handed. I mean, what's your expectation for the next edition of the Dune story and what this could mean for Timothée Chalamet?
Well, look, he's on a juggernaut campaign. I mean, him having, one movie that kind of didn't work, but he still got all those nominations, so that's huge. So I think Dune and closing out with the third episode of that is going to be big. We've got, you got with Star Wars that's happening, with Spielberg that's happening, with Christopher Nolan and The Odyssey coming. I mean, these are massive movies where we were seeing 1 or 2 a year. Now you saw like one every quarter, but now there's a lot of great content out there.
Spoiled with choice. And with that, Stacy, before I let you go, I am curious. I mean, what are you most excited to see this summer, in the months ahead?
I have a secret.
Yeah.
If you haven't seen it, go see Is God Is.
It's
a little film, but incredible. Saw it twice last weekend.
All right, I'm going to take your advice here, Stacy.
I'm always right.
That certainly helps. Stacy, it's always lovely to see you. That is Stacy Spikes. He is the CEO of MoviePass. Now, coming up, still ahead, we have what investors need to watch out for over the next week. A ton of economic data coming our way. We're going to break it down next. This is The Close on Bloomberg. A true story of war, obsession, and the world's biggest art heist. Bloomberg senior reporter Matthew Campbell out with a new book this week, The Man Who Stole the Gods, breaking down how investigators tracked down a former child soldier whose thefts drove a global art conspiracy. I'm pleased to say that Matthew joins me on set now. Matthew, first of all, congratulations, and just set the scene for us. I mean, I'm a reporter at heart, and I always wonder, how a story like this comes together and how it culminated in this book that you've put out this week.
Well, in 2019, there was a British art dealer, Douglas Latchford, who ended up being indicted federally here in Manhattan on fraud and conspiracy charges relating to his sale of artifacts from Southeast Asia. And I started looking into this case then, and took a while to get my arms around it. But it turned out there was this enormous conspiracy involving looted works from Cambodia, which ended up overwhelmingly in Manhattan, sold for millions of dollars.
Wow. And I mean, talk to us about how the U.S. got involved. When you think about U.S. law enforcement, their involvement there, when did they enter this story?
There's actually a unit of the Department of Homeland Security that investigates cases involving basically art, what they call cultural property. And that unit got very interested in Cambodia in the 2010s, and specifically in the industrial scale looting that occurred during the Cambodian Civil War, much of it by the Khmer Rouge. And it turned out that a lot of American museums and a lot of wealthy American collectors had been big buyers of this stuff, which provided an access.
Yeah, there you go. So, I mean, what have been the results when you think about the investigations that we've seen by the DOJ, other law enforcement agencies? What did they bear out?
There have been some criminal charges. There have also been a number of what they call forfeiture cases where the government seizes objects and takes them back to where they came from. And what there have also been are voluntary deals. So the Metropolitan Museum did a major agreement with the Department of Justice, which I describe in the book, to essentially hand back works deemed to have been stolen from Cambodia.
And before we let you go, I am curious, again, coming back to the reporting of it all, where did this take you when it comes to, hunting out these stories, hunting out these characters? What did your reporting process actually look like?
Beginning with a lot of documents, which is always where I start as an investigative reporter, and beyond that, it was a ton of travel. I think I was in Cambodia a dozen times, other places in Asia a dozen times, and bit by bit, you build the wall, and then it stands up.
Well, culminating in the book that you put out this week, Matt Campbell, really great to get some time with you. Congratulations again. He is a Bloomberg News senior reporter and the author of the new book, The Man Who Stole the Gods. Meanwhile, let's take a look ahead to what we're watching over the next week, because it is Friday, thankfully. On Monday, we get some global PMI data and earnings as well from HPE. That brings us to Tuesday, and U.S. primary elections across the country really kicking off. We're also going to get JOLTS data, a little bit of an appetizer for Friday, as well as some more Fed speak as the central bank really wrestles with its rate trajectory. We're also going to get earnings from names such as Dollar General. Meanwhile, Wednesday, we have the Bloomberg Global Credit Forum here in New York. We're also going to get earnings from the likes of Broadcom, CrowdStrike, and from Macy's. So an interesting mix there of some different sectors. Thursday, we have the Bloomberg Tech Summit, which features a conversation with San Francisco Fed President Mary Daly. And that brings us to the main event. On Friday, we're going to get that U.S. jobs report. We know we've been living in a low hire, low fire sort of labor market for some time now. We're going to see if any of those dynamics start to shift and what it means for the Federal Reserve, where we're hearing more and more from Fed officials that the focus should be on inflation and the price pressures that we're seeing there rather than what's going on in the labor market, which has been fairly resilient. Meanwhile, one more quick check on how we finished out this week. On this Friday, the final trading day of May, another record for the equity market, the S&P 500 finishing the week out higher by about 1.4%. A lot of that strength driven by tech. A lot of those software earnings that we were watching for came in better than feared. The NASDAQ 100 finishing the week about 3% higher, a big rally in the bond market. Meanwhile, 10-year Treasury yields falling by about 12 basis points on the week, though we're still at some pretty elevated levels. And take a look at Brent and keep an eye on it over the days ahead. Brent sitting at about $92 a barrel. Meanwhile, that does it for us here on The Close. Balance of Power is up next. Have a great weekend. This is Bloomberg.